This morning, the Fed cut interest rates by 0.25% as expected. This marks the first cut after months of keeping rates high. And notably, the Fed also left the door open for a few more cuts later this year. Immediately, the US dollar weakened, bond yields fell, and US stocks jumped as investors priced in hopes that cheaper money would flow back into the market. Bitcoin and crypto also benefited, since lower interest rates usually boost the appeal of riskier assets. However, the key point is that the Fed emphasized it will continue to closely monitor inflation and labor data. In other words, this may not necessarily be the beginning of a long easing cycle. For traders, the challenge is that market sentiment reacts very quickly in the short term, sometimes within hours or days, but a sustainable trend may not have formed yet. If you simply hear, "the Fed cut rates," and rush to go all in, that's extremely risky. What we need to understand is the logic. Lower rates, right pointing arrow; weaker USD, right pointing arrow; more support for risk assets. But markets don't always move in one straight line, because they're driven by expectations as much as by actual data. In short, the Fed's rate cut is positive news for the overall market. But traders should stay sharp. Watch how the market reacts after the announcement, instead of blindly chasing the very first wave.